Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Now here, this P&L diagram is an estimation at best. Why? Because all P&L diagrams assume that the option is held until expiration. There's a problem here. There are two options that each have a different expiration. So we can only show these at the expiration date of one of those. And to be sure, we can really only show it for the short-term option. So this is a diagram, a sort of loosely drawn diagram of our profit or loss at October expiration. The most we can lose here is 42 cents. That's the only thing we really know for sure. With the calendar spread, if you hold it all the way until the expiration of the short-term option, the most you can lose is what you paid for that spread. Now, if you hold it until after expiration, you could lose more. That's because the short-term option will either expire if it's out of the money, or it will get assigned. Remember, you're short it. You're short, in this case, a call. And if that call gets assigned, I end up with a short position. Now, because some assets are cash settled and some are actually settled in the physical underlying, like for example stocks, with a stock I would actually take possession of being short a certain number of shares. With cash settled, it's a little bit different. When I get assigned on a cash settled option, I get the in-the-money cash value if I exercise, and if I'm assigned, I have to pay the in-the-money cash value. But regardless, after expiration, what I'm left with here, certainly, is another call. The long-term call that I bought is still alive and kicking. And so, depending on the proximity of the underlying currency here, I may lose at the most 42 cents, but I might have a profit. Now remember, before I told you that you profit from time passing, and your detriment is that there would be a big move in the underlying currency. So this is kind of the drawing of that. If there's a big move away from the strike, whether down or up, I lose. And if there's not a big move and I stick around pretty close to the strike, I profit, but I don't know exactly how much I profit. And why? Well, because the greatest profit potential is reached right at the strike price, but when that October option expires, I don't know how much the longer-term option is going to be worth. I can't really tell that. Why? Because, well, I know what the strike price is, and I know how many days until expiration there are, but I don't know the volatility, and volatility is a very important component in determining the price of an option. And because I don't know the volatility, I can't tell you for sure how much I would make if we expire at the best case scenario right at the strike price. So, this diagram, although I'm showing it to you, you can kind of just forget about it and just sort of let it go out of your head because it doesn't do you much good. What you really need to look at, in this case, is the Greeks. Your delta, gamma, theta, and vega. So I have two options here. I'm short the November 68 calls. I'm long the December 68 calls. And what we do with spreads when we observe the Greeks is that we net them out. So I'm short 0.525 deltas in the November 68 calls, and I'm long 0.522 deltas in the December 68 calls. So I have a net delta of just about 0. Now, for those of you who aren't familiar with delta, that's a measure of the option value sensitivity to changes in the underlying currency. So here, if the currency goes up by 1 full point, I'd make 52 cents on the options for the 68 calls. And I'd lose about 52 cents on the 68 calls. So it's about a scratch. That's how delta works. Now, theta, on the other hand, this is kind of stated in, dollars and cents as well. Here I lose, or I'm skipping down here, by the way. For the December 68 calls, I lose about a penny a day, about a dollar of actual cash a day. But on the November 68 calls, I make about $1.20 a day. So I have a little bit of positive theta coming in. As each day passes, some of this cash kind of rolls in, as long as I don't get hurt by movements in the underlying. And my theta increases each day if we stay around pretty close to the strike and I don't get hurt by movement in the underlying. Now, let me show you what the movement in the underlying looks like. Well, take a look at the gamma. The gamma of the option I sold is negative 0.15, and the gamma of the option that I bought is positive 0.11. So my net gamma is negative 0.04. So that means that my gamma is a measure of how much my delta changes. So when EUI moves higher, my delta actually gets a little shorter. 1 full point gets me short 4 deltas. And when EUI moves lower, my delta gets longer. 1 full point gets me long 0.04 deltas. Now that means that I actually do have some directional sensitivity, and the further I move up or down, the worse my delta is for me. It moves against me. That's what negative gamma is, and that's what I was talking about when I said the volatility of the underlying. Gamma measures my risk of changes in realized or historical volatility. Now, V down here, that stands for vega. That measures my sensitivity to changes in implied volatility. And my net vega here is 2.6 cents. Here where it says positive 0.026, that's 2.6 cents. So as the implied volatility changes, as it adjusts to supply and demand from the market for options, I have some vega risk. Now, gamma can really wreak havoc on a time spread like this. When there's a big move in the underlying, it can really smart. Theta, although it looks kind of small now, as expiration draws nearer, it's going to get bigger, and you're going to start making money at an increasing rate if we sit right at the strike price. Now, this is, if you've never seen this before and you've never thought about time spreads, it can maybe be a bit to digest. If you've traded a couple time spreads before, but you want to learn how to get a little better at it, let's look just a little bit more deeply here for a second. I talked about implied volatility. Now, the implied volatility here is high relative to the historical. The implied volatility was about 11, and the historical volatility is about 7. Now, we can kind of look at that a few different ways. One is the market could think that there's going to be a pretty big move in the near future, and that's why they're pricing the implied volatility higher. However, you may look at that and you may think, well, I don't think that there's going to be a big move. I'm looking at the historical volatility, that is the annualized standard deviation, moving at about a 7%. I think that's about right. I think these options are priced too high. Well, when that's the case, if the short-term option is more expensive than the longer-term option, there is an opportunity.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.